it seems that the US administration is being encouraged to come up with more forceful policies because the financial markets are not putting the same checks and balances on them as they did earlier on the year. Welcome to Key Points for September. This month we take a look at the Federal Reserve and will they or won't they cut interest rates. We turn our attention to the lack of volatility in the financial markets, despite some pretty unprecedented policy coming from the US administration. And we look at the squeeze higher in equity markets over the summer. Will this continue into the autumn? Now, turning to our first point, the Federal Reserve really has a challenge on its hands. There's a lot of pressure for them to cut interest rates. But if you look at the chart I'm showing you here, you can see the dilemma they face. The chart shows you the blue line, which is the unemployment rate, which is running at a very low level over the last 20 years. 4.2% is historically low. So that's part of their mandate to keep full employment. The other part, however, is to have stable prices. And the red line shows you PCE inflation. And yes, it's come back a long way since the highs during the COVID period or just after it. But you can see it's still running much closer to 3% than 2%, and it's rising. So the challenge for the Fed is they've got inflation that's picking up and they've got unemployment still very low. So do they really need to cut interest rates? Well, Chair Powell said at the Jackson Hole Symposium just a couple of weeks ago that there is a door opening now for rates to be cut. Why is that? Because he sees the economy weakening and we see some signs that the labour market is deteriorating. Certainly the number of jobs being created is slowing down. So he's focusing now more on the jobs component of the dual mandate rather than inflation. He still sees this now as transitory. Even though tariffs will have an impact, he does see prices coming down later on. So the focus now is on jobs, and we suspect they will cut interest rates by 25 basis points in the coming days. Now, turning to our second point, financial market volatility has been very low despite some unprecedented US policy initiatives. If you look at the chart I'm showing you here, this is looking at 10 and 30-year Treasury yields. And you can see having moved up early in the year, remember during the kind of Liberation Day into the summer period, they've been remarkably stable, even though we've seen some big interventions by the US government. There's been a lot of pressure, as we've just spoken about, in terms of the Federal Reserve cutting interest rates. We've had the sacking of a Fed governor in terms of Lisa Cook, which of course is working through the courts right now. But the financial markets haven't put the same curbs on the US administration's ambitions that we saw back earlier in the year. Now, this is quite interesting. It perhaps suggests this won't happen, that none of these policies will come through, or perhaps there is a risk that the market does wake up to this later on. So far, we're still encouraged by this lack of volatility, but it seems that the US administration is being encouraged to come up with more forceful policies because the financial markets are not putting the same checks and balances on them as they did earlier on the year. And you can also see this on the next chart. This is looking at volatility indices for both the equity and the government bond markets. And you can see since that kind of sell-off back in April, where volatility spiked higher, volatility has been on a persistent decline, both in terms of equity market volatility and bond market volatility. Investors seem to be looking through the noise, the erratic nature around policy, and focusing just on market fundamentals, which in some ways is a good thing, but it does leave the market somewhat vulnerable because there's not a lot of being priced in for risk around policies. Now, turning to our third point around the equity markets. Markets have been very strong over the summer period, related, as I said earlier, to that lack of volatility. Institutional investors have been quite light in their positioning, and we've seen them increasing that as the markets continue to get squeezed higher. This is a momentum drive higher rather than fundamentals. But that noted, earnings season has been good. The US has showed very strong earnings growth in the second quarter, and guidance going forward was not bad either. And that's allowed the US equity market, you can see the blue line here, the S&P 500, to do very well over the summer period. Look at what's happened to the green line, Europe. Remember, that was the darling earlier in the year as people were embracing the whole fiscal spending in Germany. That struggled a little bit because it's still jammed tomorrow. Earnings there are likely to be better next year, but they've been rather disappointing so far. The other big mover, of course, has been China. The tech cycle has been doing very well, and domestic investors have been increasingly buying into that. So this is a momentum-driven market. It's not great on fundamentals. A lot of these markets are looking quite stretched, but we do think that momentum can go higher. And if we do indeed get a Fed rate cut in the coming days, there's likely to be a positive backdrop that can allow these markets to run higher for longer. But remember, risks are high. Remember, as always, you can read the full report on Zurich.com, and I look forward to speaking to you again very soon.